The Vanguard High Dividend Yield ETF, ticker symbol VYM, was created in 2006, right before the financial crisis. For those that are new to investing, ETFs are basically basket of stocks following certain strategy and methodology. VYM has a very low expense ratio of just 0.06%, typical for a Vanguard ETF. This means you will only be paying $6 per year for every $10,000 invested. It is one of the biggest dividend-focused ETFs with $57 billion in assets under management. The ETF follows a full replication approach, meaning that the fund actually owns the companies in it. This is the strategy I personally prefer because it means that every dollar I put in it goes into the holdings themselves, not into intermediaries that have swap agreements. If you don't know what that means, don't worry, it doesn't concern this ETF and is a topic for another video. The dividend yield of the ETF is currently 3.19%, which means for every $10,000 you put in it, you will get $319 as yearly dividends. The fund was created in 2006, and that is a great thing because we can see what a true prolonged recession, not like the COVID one that was covered by insane money printing, looks like, and how the ETF reacts to it. The fund's total return since inception has been 7.46% annually. The 10-year one stands at 8.6% and the 5-year at 7.22%. The dividend compounded annual growth rate, also called CAGR of VYM, has been 6.97% for the past decade, 5.6% for the past 5 years, 5.25% for the past 3 years, and finally 4.26% for the past 12 months. Now, there are several things about these metrics. The total return isn't the best, but bearing in mind the fact that the performance spans the great financial crisis, the 7.46% is not that bad. We can see that during the recession, the fund fell from about $55 per share to about $23 per share. This is a huge drop. In the span of just a year and a half, the fund basically lost half of its value. Now, this occurred during one of the worst crashes in the past 100 years, so it's understandable. And besides, as I said, if we go to the 10-year return, it grows to 8.6%, which is totally acceptable. However, what worries me here are the dividend growth metrics. When I look at an ETF, I don't like to see declining growth rates, and that's exactly the case here. The shorter and sooner the time period becomes, the worse the dividend CAGR becomes. Generally, I like to see the exact opposite. Now, granted, the past 2 years have not been the best for the economy and the stock market, and we have seen a lot of even blue, cheap, solid companies slow their growth, but here we see a decline for every period, not just the last 3 years. So, this is also something to note. We can see that the ETF had to cut its dividend by 24% from 2008 to 2010. It is obvious why they had to do it, but still, it shows that this fund is not immune to financial crashes, and both the share price performance and the dividends suffer. From that, we can come to the conclusion that VYM is not exactly a sleep-well at night type of dividend ETF, which is a bit surprising having in mind that the top companies in the fund, like Exxon, Johnson & Johnson, Procter & Gamble, Chevron, PepsiCo, and others, are dividend kings and dividend aristocrats, and not only kept but increased their dividend during the financial crisis. Of course, we have no idea what the top companies were back then, but this to me shows that probably the current composition of the fund's top companies does not exactly represent a superior quality screening process, but just luck that has placed very stable and profitable stocks among the top ones. However, most likely the proprietary filters are not enough to save the fund during crisis and help put stable companies that don't have to cut their dividend there. One of the other reasons for the weak performance during the crisis and the slowing dividend growth, despite the great overall performance of the top 10 companies, could be the fact that the ETF has 452 stocks in it currently. And unlike some other funds, like the S&P 500 for example, the Vanguard High Dividend Yield ETF isn't very top heavy. The biggest position currently accounts for just 3.61% of the fund. While this is good because VYM is highly diversified, the lack of quality screens in the index is likely allowing a lot of not so good companies to creep into the rest over 400 stocks that the fund is comprised of. In that case, we run into the problem of over-diversification. The term is used to describe a strategy where an investor allows too much mediocre and even low-quality companies in their portfolio simply for the sake of diversifying, which damages their performance and the average quality of the companies they own. Now, neither I nor you have time to go through 452 companies, but I suspect this might be the case for VYM. And here is another drawback of very widely diversified ETFs, which I also tell my students in the Dividend Method program to be aware of. The fact that after a certain point of diversification, you literally have no idea what is going on. You simply take what performance and results the fund gives you, and not only you can't do anything about it since it's not managed by you, but you can't even analyze it. When an ETF has 1,000 companies in it and its dividend goes down for the past 12 months with 6%, good luck finding out what exactly happened. This is one of the drawbacks of investing in ETFs, especially very broad ones, compared to single stocks where you can immediately analyze what is going on. This doesn't mean that such ETFs are necessarily bad, but it is just one of the negatives of investing in ETFs I point out in my program to the students so they can make their own rational choice regarding what mix of smaller ETFs, broad ETFs, and individual stocks suits their character and goals. This is why I want to invite you to my free dividend investing masterclass, for which you can find the link in the description. It is a value-packed event where you will get a ton of in-depth education for free in the span of just a few hours. So go to the description where the sign-up link is, and I hope to see you there. This is just a small part of my complete guide I did on the VYM ETF. To check the full review, go to the video that should have appeared on your screen right now or to the description below.